Gold passed $2,500 an ounce for the first time in history on August 16th. Historically speaking, that should not have happened. But the same force that propelled gold to new heights during a tightening cycle is set to continue driving gold when rate cuts begin, and silver may be the largest beneficiary of the next cycle. Gold and silver have been linked for thousands of years as the original monetary metals, and their values are tracked closely. The gold to silver ratio is used by investors to gauge price movements and disparities, and this only works because of gold and silver's well-known relationship. Silver has a lag on its spot price. If we see gold entering a sustained trend upwards, most investors will look at silver expecting it to follow upwards on a delay. So the first thing many silver investors do is look at the price action on gold and the fundamentals driving it upwards. And right now, gold has some amazing backers. Throughout history, gold has performed poorly during periods where the interest rates are rising and sustained at high levels. And yet gold has done remarkably well since the beginning of the current tightening cycle in March of 2022. When rate hikes were announced, gold was trading over $19.50 per ounce. Investors, initially skeptical of gold's performance in a high-rate environment, began selling. Gold dropped over the next several months until it bottomed out in October, where it traded for less than $16.50 per ounce. This was a substantial decrease, but something unusual happened. Without any rate cuts, gold began a long hike up and has not stopped, recently breaking yet another record by trading over $2,500 per ounce. Now, there are many reasons that gold has performed well. Some may point to war. Russia invaded Ukraine in February 2022, and Hamas brutally attacked Israel in October of 2023. Fear of conflict escalation will always drive safe haven investment demand. But we have seen with gold that global conflicts tend to provide only a short-term boost. Hints of a rate cut start date have certainly contributed towards gold's ascent, as well as the bank run that began in March of 2023 when Silicon Valley Bank collapsed. And all of those are true, but one of the consistent drivers of demand for gold has come from central banks. According to the World Gold Council, central bank gold demand has been incredibly strong since 2022. In 2021, central banks bought just over 450 tons of gold, and in 2022, central banks bought 1,081 tons of gold, a 240% increase. In 2023, central banks went on another buying spree, coming in at 1,030 tons of gold. And in 2024, central bank gold buying has surpassed all records in the first half. The official numbers come in 6% higher year over year. We'll see what the year end brings, but it's notable that gold's solid base of support from central banks does not appear to be slowing down. Some gold watchers may know the People's Bank of China has paused purchases in light of the high spot price of gold. While this might be of some concern to those hoping to see a continued rally in gold spot, there are a couple of indicators that China's not done buying, and that even if they stop, it may not matter. First, China paused gold buying, and gold spot prices continued to increase in spite of their pause, hitting fresh records and new all-time highs. If they are intending to time the market, they are falling victim to hubris. Gold's ascent with China's absence indicates that China is not a market maker for this asset. Second, China's gold holdings sit at about 5% of their reserve assets. This is low, as many other central banks intend to maintain 10 to 20% of their reserve assets in gold. And when central banks have been polled, the historical position of gold holdings is one of the strongest considerations for how much they intend to hold. Less than 9% of central banks surveyed responded that a historical position is irrelevant. We are expecting to see a rate cut sometime this year, most likely September. And that is typically when gold performs its best, during periods when interest rates are lower. There's more appeal to hold gold when other safe haven assets like treasuries are no longer paying as much of a yield. What gold does next remains to be seen, but the fundamentals look strong. And oddly, silver stands to benefit the most. There are many predictions of gold prices moving up, with bolder and bolder claims emerging as time marches on. One of the next most likely targets is for gold to hit $3,000 an ounce. Now, this is one of the more modest forecasts we've seen, as others have predicted $5,000 gold and higher. And although $3,000 an ounce seems like a rather lofty number, it's less than 20% higher than its current level. We have had periods where gold has jumped over 20% within a year. It's not common, but it has happened more than once in the last decade. And 20% within 2 or 3 years is fairly common. The gold to silver ratio is often used when forecasting silver's potential. It describes how many ounces of silver are used to purchase 1 ounce of gold. If we use the last year as a baseline, the gold to silver ratio should range between 72 and 91. Currently sits at 86.55. If the ratio were to drop to 72, then silver's value would climb to 34.88, a 19% increase. This would be without gold rising at all from its current level. But if we buy and hold silver now and gold rises to $3,000 per ounce, it's possible that silver also rises in response and the ratio could decline. In that scenario, silver could potentially increase to trade between a range of 34.88 and 41.66 per ounce. This means silver has the potential under this style of modeling to provide a 42% return. Compare that to gold's projected 20% return, and you can begin to see why an investor would start thinking long and hard about whether to add more silver or gold to their portfolios. Although those numbers are exciting, there are some assumptions made to create that forecast. It assumes gold will indeed continue to $3,000 per ounce. It assumes that silver will follow historical trends and react to the spot price of gold. It assumes that the gold to silver ratio will maintain its recent range and neither improve nor decline. And it does not take into consideration the psychological barriers that affect all markets. There is also profit taking that occurs aggressively with a higher beta investment like silver, where investors are eager to lock in some profits, creating downward pressure on silver spot. Silver has its own fundamentals of support in the industrial sector that are not going away anytime soon. With strong fundamentals and a rapidly rising gold price, smart investors are weighing the pros and cons of adding to their silver position. For those of you investing in precious metals, drop us a comment down below and let us know which metal you prefer to hold. Are you adding to your gold or silver position, or are you waiting out the market for a new entry point? We'd love to hear from you. And that's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.